That's the entry model. Entry, stop, target. I've promised it to you twice now. So here it is. And here's why it doesn't work yet. Because those three things are outputs. They need an input. And the input is something you can only get by hand. This is 30 days of one trader's log. Not analysis, not predictions, just observations written down. And look what falls out of it. 21 of those 30 days, the high or the low of the day, formed inside the same 90-minute window. Nobody told them that. They didn't read it in a book. It came out of the log. 20 minutes a day, 30 days. Today we build yours, and by the end of this video, you'll have the first entry in it. 5 steps. Let's go. Before step 1, 90 seconds of why, because the routine only makes sense if you know what you're looking for. There are 2 ways to look at chart. One says price moves because of what the indicators say. Overbought, oversold, a crossover. The signal causes the move. The other says price moves toward orders, toward places where a lot of people have agreed in advance to buy or sell. And here's the thing. You don't have to pick a side on faith. One of those 2 is checkable. The other isn't. You can open a chart and count how often price ran an obvious high before it turned. You can't count how often RSI caused anything. That's the whole reason for the log. Not belief. Counting. One thing I want to correct, because you'll hear it constantly. Central banks set the price. For a floating currency, euro, pound, yen, they don't. They're the largest single force acting on it, and unlike you, they announce what they're going to do in advance. That's different from setting the price, and the difference matters. Some currencies genuinely are managed or pegged. We're not trading those. And one more. You'll hear people say that if you made money before this, it was luck. I don't think that's true, and I'm not going to ask you to throw anything away. I'm going to ask you something harder. Be able to say why it worked. If you can't, that's the thing to fix. And a log is how you fix it. Step 1. Pick one asset. 1. Not 10 pairs. Not whatever's moving. One instrument for 30 days. Because you're not looking for opportunities right now. You're building a reference. And a reference needs the same subject every day, or there's nothing to compare. Step 2. For charts. For fixed windows. And each of these numbers has a reason. The numbers matter less than the reason, so listen for the reason. Daily chart. 9 to 12 months. Why that? Because that's roughly one full turn of the seasonal and quarterly rhythm. Enough to see where the year's big levels are, and not so much that it blurs into a 5-year smear you can't read. 4 hour. About 3 months. That's your swing structure. Long enough to hold the last 2 or 3 proper legs. Short enough that every high on it still matters. 1 hour. 3 weeks minimum. This is your bellwether. 3 weeks gives you the weekly ranges, and weekly ranges are where most intraday reference points come from. And 15-minute. 3 to 4 days. No more. Here's what happens if you ignore that. Now watch. Same chart, same market. 3 weeks of 15-minute data is noise. 4 days of it is a footprint. Right? Pause here and actually set these up. I'll wait. 10 seconds on the clock, and honestly, take longer if you need it. Good. 2 down. Step 3. What you actually mark. And first, the rule that makes this work. You're not forecasting. Don't guess what's next. Don't write down where you think it's going. You are counting what already happened. That's it. For things. Every day. 1. Displacement. Anywhere price left a level in a hurry. Not drifting. Leaving. Big bodies, small wicks, no pullback. Somebody was not price sensitive there, and that's the footprint. Mark where it started. 2. Highs and lows price hasn't come back to. If price made a high and never returned, the orders that were left there are still there. Untested is the whole point. Once it's been revisited, it's usually spent. 3. Clean, equal highs and equal lows. Retail calls this a double top and sells it, which means, and this is the only thing you need to remember, there is now a very tidy pile of stop orders just above it. Two people looking at exactly the same shape. One sees a reversal pattern. The other sees a target. Mark every one of these you can find. They're the highest value thing in the whole log. 4. And this is the one everybody skips. For each day, what time did the high of the day form? What time did the low? Not the price, the time. Because price levels are different every day. Times repeat. And the whole point of a log is to find the thing that repeats. Here's the whole thing as a table. Date, day of week, time of high, time of low, which session. Did it sweep an obvious level? Yes or no? 1 line per day. 6 columns. 90 seconds to fill in. There's a copy of this in the description. Take it. It's free. It's a spreadsheet. That's all it is. Step 4. Carry the levels down. Start on the daily. Mark your 2 or 3 most obvious highs and lows. The ones where price clearly got pushed away. Now, watch this because it's the habit that makes everything click. Take those exact levels and put them on the 4-hour, then on the 1-hour. Same prices. Nothing new. And here's what you'll notice within about a week. The smaller time frames start building their own little highs and lows right underneath the big ones. That's not a coincidence, and it's not you seeing things. That's what a level is. A place where the smaller time frame keeps reacting. Step 5. 2 sets of charts. Always. 1 workspace for logging. 1 for trading. Never the same one. Because a chart you've been annotating for 3 weeks is not a neutral chart anymore. It's an argument. And when you've spent that long building an argument, you will find a way to take the trade that agrees with it. Keep the analysis. Trade the clean one. And on the 15-minute, 1 habit every single morning. Draw yesterday's high and yesterday's low and extend them forward. 2 lines, 10 seconds. Then just watch what today does to them. That's day 1. And this is what 30 of them look like. You're not going to find a secret. You're going to find a tendency, and that's better because a tendency is something you can put a number on. 21 out of 30. That's not a rule. It's an edge you found yourself on your instrument with your own eyes. And now, those 3 markers from the beginning have something to sit on. That's the input. Next episode, we build the output. For ways I've watched people wreck this, all 4 are avoidable. 1. Over-annotating. If your chart has 40 lines on it, you have 0 levels. 3 a day, maximum. 2. Marrying the bias. The log is a record, not a forecast. The moment you write down what you think will happen, you've started arguing instead of counting. 3. Logging without reviewing. Data you never look at as a diary. Friday, 20 minutes, read the week back. That's where the pattern shows up. Not in the writing, in the rereading. 4. Quitting on day 9. 9 days looks like noise. It is noise. The pattern doesn't surface until somewhere around 3 weeks, and almost everybody stops at 9. If you only take one thing from this video, get to day 21. So, one asset for pains, 6 columns, 20 minutes. Do today's entry before you close this tab. Just today's, 1 row. And tell me in the comments what instrument you picked. Then on day 21, come back and tell me what time your highs kept forming. I want to see if we all find the same window. Next episode, entry, stop, and target. For real this time. You'll have the input by then. Go start row 1.